Welcome to The Explainer. We all have to make these big, tough choices where we just can't predict what's going to happen. Well, today, we're going to break down the science of how to do that and how to turn a gut feeling into a seriously structured, logical process. All right, let's just jump right in with a classic, high-stakes decision that businesses have to make all the time. Imagine this. You've got a pile of cash to invest in one of three properties. Each one has a totally different potential for profit, but it all hinges on something you have absolutely no control over, what the economy is going to do. So, where do you put your money? So, how do you even start to tackle a problem like that? Well, first things first, you need a map. You need a way to see all the possible paths laid out in front of you, nice and clear. And in the world of decision analysis, that map has a name. It's called a payoff table. And here it is. See how neatly this thing organizes the whole situation? Down one side, you've got your choices: apartment, office, or warehouse. And across the top, you've got the future events you can't control. In this case, whether the economy is good or poor. And those things you can't control, we've got a special name for those. They're called states of nature. And this is so important. We're drawing a clear line between what we control, our investment choice, and what we don't control, how the economy does. That separation right there, that's your first step to getting a handle on any huge decision. All right, so let's get into the nitty-gritty. What do you do if you have zero idea what the economy is going to do? No forecast, no crystal ball, nothing. Well, it turns out you can still make a call, and it often comes down to your own personality. Are you an optimist or a pessimist? Okay, let's look at the super optimist. Their strategy is called Maximax. Pretty simple, right? It means maximize the maximum. They just scan the whole table, find the single biggest number, that beautiful $100,000 from the office building, and say, yep, that one. Now, on the flip side, you've got the pessimist. They use maximize the minimum. They look at the absolute worst thing that could happen with each choice and then pick the best of those bad options. For them, it's the apartment, which guarantees they'll walk away with at least 30 grand, no losses. But wait, there's more. It's not just about being optimistic or pessimistic. Some people just really, really hate regret, that what-if feeling. So they use something called mini-max regret to try and avoid that buyer's remorse. And then you have the complete neutralist. They're like, look, I have no idea, so they just assume everything is a coin flip, a 50-50 shot, and they calculate a simple average to see what looks best. And this is what's so wild when you lay it all out. The right answer completely depends on how you look at the world. Only the die-hard optimist goes for the office building. Pretty much everyone else, the pessimist, the person who hates regret, the neutralist, they all land on the same, safer choice, the apartment building. It just goes to show you, the best decision isn't always about the numbers. It's about the philosophy of the person making. Okay, but what if we're not just flying blind? What if we actually have some data, an economic forecast, say, that gives us real probabilities to work with? Well, this is where we shift gears from just our gut feelings to some serious math. And to do that, we bring in a super powerful tool called expected value, or EV for short. Think of it as a way to boil down all those what-ifs into a single, hard number for each choice. It's a way to let the data guide us. Okay, let's put this into action. Let's say the experts tell us there's a 60% chance of a good economy and a 40% chance of a bad one. The moment we add those numbers to our table, the whole game changes. We're not just looking at raw profit anymore, we're looking at a weighted average. And the office building is the perfect test case here. It's the ultimate high-risk, high-reward play. You could make a massive $100,000, but it's also the only one where you could actually lose a ton of money, 40 grand to be exact. So how do you possibly balance that huge potential win against that really scary potential loss? Well, the answer is expected value. You take that 60% chance of making 100 grand, factor in the 40% chance of losing 40 grand, you crunch the numbers, and it distills that whole roller coaster of possibilities into one simple figure, $44,000. So now we do that for all three options, and suddenly a clear winner pops out. The office building, with an expected value of $44,000, is now, statistically, the smartest bet. It edges out the apartment's $42,000 and just leaves the warehouse in the dust. The probabilities completely flipped our decision. Another great way to see all of this is with something called a decision tree. It's basically a visual map of the whole problem. You start with your decision. That's the square. That leads to the chance events. Those are the circles, which then lead to the final outcomes. It's just a really neat, logical way to see how you get from choice to chance to consequence. Okay, so this brings up a really cool question. Having those probabilities was a huge help, right? But they weren't a 100% guarantee. So let me ask you this. How much would you pay for a crystal ball? I mean, what's a perfect prediction of the future really worth? You might be laughing, but believe it or not, there's actually a formal calculation for this. It's called the expected value of perfect information, or EVPI, and it tells you the absolute top dollar price you should ever pay for more information before you make your move. So for our real estate dilemma, that number is exactly $28,000. And that number is pure gold. It means if some market research firm comes to you and says, hey, for 30 grand, we can give you a perfect forecast, you tell them to take a hike. But if they offer it for $20,000, now you're talking. It puts a real hard price tag on certainty. But, and this is the final big twist, even when the math is perfect, even when it points to one logical answer, we humans have this funny habit of ignoring it. And what's crazy is, we often do it for perfectly good reasons. Just think about car insurance. Let's say your policy is $500 a year. But when you do the math, based on the tiny, tiny chance you'll have a huge wreck, the expected annual cost of not having insurance is only like $80. The math is screaming at you, don't buy the insurance. It's a bad deal. So if the numbers say it's a bad financial move, why does pretty much every single person who owns a car buy it? Are we all just terrible at math? No, of course not. Something else is going on. And that something else is a concept called utility. Utility is this fantastic idea that the value of money is not the same as the number on the bill. I mean, think about it. Losing your last $1,000 would be devastating, right? But a billionaire losing $1,000, they wouldn't even notice. The personal satisfaction or the pain we get from money is not a straight line. And that is the key to the whole insurance puzzle. We are, as the experts say, risk averters. We are more than willing to pay a little extra, that difference between the $500 premium and the $80 expected cost, for one simple thing: peace of mind. We will gladly take a small, guaranteed loss to avoid a small chance of a totally catastrophic one. So the next time you're staring down one of those big, uncertain choices, just stop and ask yourself, what lens am I using right now? Am I being the mathematician, just playing the odds? Am I being the optimist, chasing that one big win? Or am I being the pessimist, just trying to protect my downside? Because the real power here isn't about finding one single right answer. It's about understanding which framework fits your situation and, more importantly, fits you. And that's how you make a truly smart choice.